Hey everybody, Randall Cornet here. Hope you guys are having a great day. Wanted to make a quick video touching up on the video that I made yesterday. I had a lot of questions, so we're going to go over that. That being said, if you enjoy the content, please do me a huge favor and follow and subscribe. That does me wonders when it comes to spreading the message out and connecting with more apes. So that being said, we'll jump right into it. So today we did have a pretty strong day. Right off the opening rip, we had a nice run. And then we actually continued to go up. We managed at one point to reach $63.12 as the high for the day. We did kind of dip towards the end of the day, but we've seen some nice consolidation around $60 in the post market. So moving past the charts, and what I really want to get into is this chart right here. A lot of people have been looking at this chart, and I've been seeing it float around Reddit, YouTube, Twitter, and I do think it's relevant. I think it's important, but I think the big number that people have been talking about is the short volume, the net short volume. Well, and obviously the amount of money that's being traded in the dark pool is insane too. But I wanted to address something about the short volume. So you could see if we hover over this candle right here, it'll say short volume is at 37 million. And that scares a lot of people. And it is a scary number. But one thing I wanted to highlight, if you scroll all the way to the bottom here, and this is the video that I covered yesterday, short volume represents the aggregate volume by security for all short sell trades executed and reported to a TRF, the ADF, or the ORF as reported by FINRA. TRF is just like trade reporting facilities, so it could be anything that's basically off exchange, dark pool, all that stuff. So I'm pretty sure with these numbers they lump all of them into one, anything that's basically not on the exchange. So although it may seem noisy and a rather poor factor in its own, it has been shown by squeeze metrics that higher short sell volume, so let me say that again, higher short sell volume tends to lead to abnormal positive returns. The argument is that short sell volume mostly represents shares sold short by market makers to investors buying the stock. These investors are referred to as dark pools since the FINRA TRF trades are from off-exchange venues. More details can be found on the white paper. So one thing that I want to mention here is, okay, so they're saying that short sell volume mostly represents shares sold short by market makers. So it's you going to an exchange, buying the stock. The market maker is actually taking on a short position since they don't actually own the stock. So when you as a buyer get that stock, the market maker is actually initiating in a short position. Well, don't be fooled. Dark pools have market makers too, and it works the same way. So they're saying that basically when it's representative of investors buying stocks. So think about this, like if you're a hedge fund or a market maker, and a lot of these market makers are in bed with a lot of these hedge funds that we're fighting. So if you're a market maker / hedgy and you're taking on dark pool transactions, right? And let's say the exchange is routing the buy orders to the dark pool. So our buy orders. So number one, they achieve two things. They basically suppress the price because none of that gets reflected on the lit exchange or anything that happens on the dark pool. So your buying power basically has no impact in the dark pool. And then number two, they in essence, when that order gets routed there, they make money on the spreads. That's a big game in the dark pool, is the spreads and basically hitting between the bin and the ass. There's a lot of money that's being flown and a lot of profit to be had there. So there's two reasons why they're doing that. So you have your buy order getting routed to the dark pool, and then the dark pool is executing those orders. So that basically when the market maker in the dark pool executes that order and let's say sells that stock, that market maker in the dark pool is actually initiating a short position, which you would see represented here, right? Or the short volume. Well, today the short volume was 37 million actually. So that number, and what's really unique about this, if we pull up our squeeze metrics chart, which is the people that wrote that whole white paper, what I want you to pay attention to is this top or left corner. When I hover over the bar, there's going to be some information here. So when I hover over this, that number, well, it doesn't actually look like it's been. Let me refresh this real quick. I haven't refreshed this in a little bit. So they're saying, okay, short volume today was 14, for the 17th was 14 million, and the net short volume was 5 million. So we come over here, let me refresh our chart. I might have to relog in, dang it. Sorry guys, that's okay. We will be all right. What the heck's going on? There we go. Okay, so let me pull this up again. Sorry for the delay. So we see 61 million in short volume, which is that. Remember, I was saying, look over there to the left. I want to see if these numbers actually match up. So that dark blue bar would be, or box that you see on the left of the screen. I have to keep my mouse here, but that dark blue, so it's up here, guys, one more time. So the dark blue box is representative of short volume, which AKA is buying volume. If you go to their, basically their glossary or their key or their index, you could see dark blue is dark blue buying volume, AKA short volume. So we'll come back to the chart and we could see that the short volume was 61 million today for the 17th. And that's what they have so far. Let's go and check that compared to stock grid. Let me refresh this one more time on AMC. And let me type it in up here. Sorry, I should have turned that off, guys. That's subscriptions coming in, and I apologize for that. So they say their short volume was 61 million. And what do we see over here on Squeeze Metrics? 61 million. So that is actually an indicator of short volume being buys. And so this is what's interesting, though. So we are still getting attacked in the dark pool. This is not like, oh, the Holy Grail, like it's great news, because the selling pressure is outweighing the buying pressure actually in the dark pool. The light blue is actually the selling pressure that's going on. So who knows, whoever's buying these stocks in the dark pool could be taking them into the lit market, using them against us. Actually, a big reason why the price is getting suppressed, because if they're trading, or they're issuing basically our shares, and market makers are sending our shares to basically, you know, dark pools or off exchanges, we're not seeing that buying power reflect in the market. Again, that's super important. And then what happens is they're doing that and they're making money in the middle time, basically the intermission, by quoting spreads and make their money. They're making their money there. So another important thing. So I did cover this article in the video, but I'm not going to read the whole thing again, but a part that I left out that I will read here. So we're talking about, they say they're making the case of basically short as long. So short sell, you guys know what that is. But according to the SEC, you know, trades marked with a seller short compromise about 49% of all equity volume. So if you believe in speculation, like that's actually real speculative shorting going on, so people are actually believe the stock's going to go down, is 50% of all equity. That's not the case. It's highly unlikely. So what they say is, to understand, you need to know how market makers do business. Traditionally, market makers make their money by quoting a spread. This means by placing a bid at, say, $19.95 and an offer at $20 comes through. Since the market makers have no position in the stock, the offer at $20 gets filled, and that position or that transaction is reported as a short or a short sell. This means that whenever a market maker fills an investor's buy order, the market maker is facilitating the trade by shorting shares. Thus, short volume is actually representative of investor buying volume, and non-short volume is representative of investor selling volume. It's no coincidence that short volume is predictably half of total volume on the majority of days, because short sells represent the buying half of the market, and long non-short sells represent the selling half. So I thought that was highly unique. And then there's an interesting thing here that I thought was, I didn't read this yesterday either. Back in 1997, when the U.S. market's tightest spread was 12.5 cents, the Island ECN, an off-exchange trading venue for NASDAQ stocks, started doing something different. They paid market makers to do what market makers already do: quote a spread. Whenever a trader took the liquidity that the market maker posted at the bid or offer, the trader would pay a small fee, and most of that fee would be given back to the market maker, basically as a rebate. What does that known as? Payment for order flow. As a result, that's literally what it is. So as a result, Island attracted all kinds of market makers, ending up with tighter spreads and more depth than their competitors. Naturally, customers like this, and within 2 years, Island had gone from 3% to 13% market share of NASDAQ volume. The idea caught on, and other exchanges, public and private, started using the market taker model as offering rebates, payment for order flow, so spreads tightened everywhere. So hopefully that gives you guys a little bit more insight to what's going on and what you guys are looking at with the data. I thought it was super interesting. So that being said, looking at some more dark pool data, we will take a look at what happened today. So, and this is really crazy. Somebody made some money today in the dark pool. So there was sorry guys, I will promise I'm going to take that off for next video. So there was 1.4 million dark block purchase, $79 million. They went through. They executed this trade at $55. Such a large volume purchase. I mean, that person made some dough. We don't know what they really did with those shares yet, but that's a large purchase. And regardless if it happened in the dark pool or not, it's a big commitment, just, 20 million under $100 million. And so that's what these orange bars on this graph indicate, by the way, is the, oh, you guys can't see this. Let me move this over just a little bit for you. There we go. Okay, so you can see the numbers a little bit better. I was kind of cutting off the screen a little bit. So that's a big buy. So $80 million to spend in the dark pool and AMC shares. That's 1.4 million shares. And then look, there was another block, 120,000 shares, 7.2 million. And then another 160,000 shares, and that was 10 million. And you could see these orange bars are kind of representative of the price that these dark pool transactions actually happened. So with that being said, we will take a look at Market Chameleon and look at the overall dark pool data for today. So it's actually reduced a little bit. It was 62% for the past couple of days. So there was a little bit less, about -2% in the dark pool. Total volume, basically the dark pool accounted for 58% of everything that happened in the market today. And that was 151 million shares being traded in the market. Oh, and one last thing that I'll come back to actually on this white paper that I left out. So basically we were going back to the rebate, the payment for order flow. By 2005, when the SEC's regulation NMS officially made sub-penny pricing a reality, nearly everybody had adopted the market taker model. By then, market makers made more money by collecting payment for order flow than the traditional business of quoting spreads. This is a new environment. There were tiny margins and no margin for error. Only the very fastest market makers would get the rebate or payment for order flow. High frequency trading is primarily the story of the mad scramble for these rebates. If you submit an order to buy 100 shares of XYZ at the market, you will buy those shares from a high frequency trader market maker. If you later submit a passive limit order to sell 100 shares of XYZ at the offer, you will sell those shares to a hedge fund, to a high frequency trader market maker once someone buys 100 shares from him at a higher price elsewhere. They call this front running, if you like, but competition by market makers to garner the rebate has actually been a boon for the average investor. So I hope you guys enjoyed the content. Again, if you did, please do me a huge favor, drop a like and subscribe. It goes super far for me, and I will be on later tonight for a live chat for the pre-market. So I will catch you guys then. Thanks and love you long time. Peace.